This is just a rough gauge, but there's your near 16%, SEP 81 for your anniversary date. And the whole point of this chart is that we have a lot of potential room to run to the upside. So if somebody asked me and held a gun to my head and said, listen, the worst case scenario, where Treasury rate's going to go 10-year, I'd say in the next 7 years, you should be able to see 13.5%, 14%. Yes. Now, I'm not saying we get there, but I really want to stress you do not want to jump in front of this right now. But
well, what do you think about 15% mortgage rates? When Rick Santelli drops an absolute bomb on his latest warning, it's a game changer for the housing market. Imagine a world where the 10-year Treasury yields hit a staggering 13.5%. Well, it doesn't sound so far-fetched to my man Rick. Over time, we typically see about a 1.75 or 175 basis point spread between the 30-year mortgage rate and a 10-year Treasury. Now, you may hear a lot of people say that the 30-year is loosely tied to the 10-year. Well, that's what they're talking about. Well, right now, we're actually seeing about a 300 basis point or 3% spread. And, I'm just using the averages at the moment. That would mean if Rick Santelli's prediction is correct, we're looking at 14.75% mortgage interest rates. So if you're not familiar with the 10-year Treasury, it's kind of a heartbeat for the global economy, and it's been in the news quite a bit recently. The 10-year has risen to 4.75, and when it rises, so do mortgage rates typically. Historically, as I mentioned, mortgage rates average about 175 basis points above the yield of the 10-year. Right now, it's about 3% higher. Again, that's why we're seeing mortgage rates at about 7.75% to 8%, because the 10 years at 4.75%. Now, have you heard any of the baby boomer generation, or are you part of the baby boomer generation that is talking about, I had interest rates at 16% in 1980 or 18% in 1981, and you guys have it made, and we certainly did for a very, very long time. The X generation, the millennials, and even some of the Z generations, we've had it made with much lower interest rates. So if this comes true, interest rates up to that 15.75 or 14.75% level, does that mean that argument no longer holds water? Are we no longer going to hear from those that had those incredibly high interest rates back in the early 80s? Is that what's going to happen? Now, I would argue, and math is there, the major difference, of course, is the median home price in 1981, was $64,000 and $69,000 in 1981. Whereas in today, 2023, we're at $420,000 plus, give or take, depending upon when you're actually watching this video. All right, let's just say this comes to fruition and the median home price actually takes a major hit. We have this major crash and we actually see 25% reduction in the median home price. That's about $336,000 is the median home price. Now let's compare a payment of $860 principal and interest versus a $4,181 principal and interest payment from 1980 versus 2023, if this were to take place. Even if I take it to a 15-year term, that monthly payment is $939. It's called $940. Now the average median income has increased. So if this were to come to fruition, would you argue that now the millennials, the Z generation, the X generation now have it even more challenging than the baby boomer generation? What are your thoughts on that? Please comment below. And in fact, if you are seeing any value, you like the video, please do me a favor, hit the thumbs up, hit the subscribe button. I appreciate it, and we certainly appreciate you following along. Now, I fully understand that it's all perspective, right? I mean, when you're in 1980s, when that was taking place, I'm certain it felt like it was the end of the world and it was absolutely unaffordable. I 100% can imagine that being the case. But I would argue that that's similar to what a lot of the younger generation is dealing with right now. They feel as though nothing is affordable, can't get into housing. Gas prices are starting to increase again. Inflation obviously is going through the roof, similar to that late 70s, early 1980s phase that we went through. All right, now Santelli's warning, he's just not, it's not random. He's been around the block for a long time, based on years of financial expertise. He's got a pretty deep understanding of market dynamics. And if he's right, we're on the brink of a pretty serious economic shift. So what happens when this yield potentially doubles or even triples? Home ownership for the majority of everybody could become literally a distant dream. Monthly mortgage payments could skyrocket, making it nearly impossible for the average family to buy a home. Think about this. 574 out of 578 counties, or 99%, are less affordable now than their historical affordability averages. Last year at this time, 96% were less affordable. In 2021, 48% of the 578 were above their historical averages. Clearly, this would be a major problem and something would have to give. Is your employer going to pay you more to keep up? Chances are probably not. They're dealing with very similar issues with the rise of cost and that you're dealing with on a regular basis. The costs it takes to run their business, they're dealing with the same challenges. So in order for them to pass on any sort of additional income is going to be incredibly challenging. In fact, I think we all know that what's more likely to happen is layoffs will take place or could possibly take place as mortgage rates climb, home affordability plummets. This could lead to a decrease in demand. We hear about all the time. If rates drop, demand's going to skyrocket. This could cause home prices to drop. Current homeowners, that might mean watching their home values decrease significantly. If you're looking, you believe this is to be true, do you get out now? Do you take the cash and go rent until prices become more affordable? If that's the case, then what happens to rental rates? Again, we're in a supply shortage, right? So now all of a sudden we have more folks out there trying to rent a home or an apartment, and now all of a sudden the rental rates start to skyrocket. What about if you're looking to buy? Do you lock in the low rate of 8% with a manageable payment, or wait and deal with an increase in rental rates year after year? Certainly a tough dilemma, a lot to consider if this becomes a reality, for sure. Before I let you go, I'm going to leave you with one last clip.
Why are rates going higher? It's because the economy is gangbusters, easy. Or because
Tyler Matheson. Everybody clap for who loves Tyler. I love Tyler. And what did he bring up today? A great Chicagoan, Milton Friedman. And when he did, one of my 50-year veterans from the trading floor called me and said, "Boy, he's spot on." I had many meetings with Milton. That if you want to know where inflation has taken the markets and why, just look at government spending. The vigilantes have new horses and they're riding, and I really do think that is the answer. We are spending too much. We are not learning to cut back. As a matter of fact, I think we're out of control as we approach a $2 trillion deficit, and this is the market's way to get Washington's attention.